Hi, I'm John with Tax TV, here with general information about two estate planning techniques with some unusual names: GRATs and GRUTs. Grantor Retained Annuity Trusts, GRATs, and Grantor Retained Unit Trusts, GRUTs, are both irrevocable trusts that allow the donor to retain the right to receive income from the trust either in fixed annuity amounts each year for GRATs or as a fixed percentage of the fair market value of the trust assets each year for GRUTs. Here's how it works. When you set up one of these types of trusts, you transfer an income-producing asset like a family business, stocks, or real estate into an irrevocable trust for a set number of years. During this time, the trust pays the donor income. At the end of the trust term, ownership of the assets transfers to the beneficiaries, usually the donor's children. These assets will not be included in the donor's estate when they die. If, however, the donor dies before the number of years designated in the trust, some or all of the assets may be taxed as part of the donor's estate. But these trusts aren't for everyone, since there are downsides. For instance, the grantor loses control over the trust assets. Also, the donor will have to pay tax on any income from the trust, whether or not funds are distributed to him. And because the trusts are irrevocable, the donor will be making a taxable gift to the beneficiaries. The value of the gift is determined by using the IRS valuation tables that assume the property will realize a certain rate of return during the trust term. This is known as the Section 75/20 rate. Lastly, GRATs and GRUTs are generally not appropriate for transfers to beneficiaries that are 2 or more generations below the donor because of generation skipping tax. To find out more information about trusts with unusual names like Q-tips and crummies, check out taxtv.com.